Hello, everybody. Good morning and happy. Welcome to Brunch with Brandon here this week. It's been a little while since we've done one of these, but we are in the midst of earnings season right now, and so we wanted to just kind of take a minute and talk a little bit about what earnings season is, what to maybe watch for during this period, although we're a little ways through it, and just kind of break down what has happened so far and what we're kind of watching in the remaining last few innings here. So again, we are right in the middle of this. Most companies have reported earnings so far, but let's start off just really talking about what the heck earnings even means. Like, what is earnings season and what is going on right now? So basically, to back up entirely, every quarter public companies report their revenue or sales, if you want to think about it that way, and their earnings or profits. Okay, those are the two biggest numbers that are reported in each of these quarterly updates. The idea is that these are public companies. They need to report to the public market. And basically, this is how investors determine whether or not they want to invest, what price they feel is best, and get a little glimpse into what these companies are really addressing. Typically, in addition to just sales or revenues and profits, these companies also share some challenges or opportunities that they are facing in their industry or just in general in the economy. And again, the whole idea here is to really share with investors what is going on and open up the books a little bit so that we all can make as informed decisions as possible, again, because these are public companies at the end of the day. Now, what is really important is the way that earnings factor into the prices and the stock market in general is that there are obviously a lot of analysts out there that offer predictions on these different companies. So analysts from, all the large companies in the world that, we can probably all name off the top of our heads, offer predictions on how these companies might report their earnings every single quarter. All right. Now, when you hear that a company has either beat or missed their earnings expectations, this is really showing that that company's earnings or sales and profits earnings or profits and sales or revenues came in either above or below what the analyst's expectations were. Okay. Why this is so important is because every single stock is all priced based on expected future earnings. No companies are valued based on today. They are always forward looking. And so when we are looking at a stock before it actually shares its earnings, typically that price is based on what those expectations were, right? Now, when a company's earnings come in below that expectation, as you might imagine, it often means that the stock may drop a little bit based on, the higher expectations that they had going into this earnings call. It may come down a little bit to better align with the company's earnings and, more importantly, the future earnings potential, right? That is really what is most important in this. Whenever analysts are looking at this, whenever a stock is trying to find its price, and obviously it's never right is the key with public markets, it is always basing it on the expected future earnings, which is why obviously, some analysts may have different opinions on what that looks like and therefore different price targets. What's really important with this is that the valuation, it's always based on future earnings, but it could be entirely different for one company versus another. So for instance, a company like, let's say, Facebook or Amazon or Google, right? Some of these much larger, more growth-oriented companies, those valuations might be much, much higher. In other words, the expected earnings, there may be a higher multiple from that earnings to the price that you pay because you're expecting more growth in the earnings in the future. Whereas a value type of company, think about, Coca-Cola or Procter & Gamble or Verizon, some of these, let's call them more boring maybe companies, but strong, they may have a much lower multiple applied to that future earnings. So let's just say in each of those scenarios, the future earnings were the same. You may pay a higher price for Google than you would for Verizon because you're expecting that earnings growth in the future would be much quicker. Okay, I hope that makes sense. Now, what is also important to share is that each of these companies, when they report earnings, they also offer guidance on their earnings calls. So even if a company were to beat on their earnings expectations, but suggest that the future guidance or future earnings could be lower, you may actually see that stock price drop due to that same kind of phenomenon that the market had expected, higher earnings, and the company is sharing that in fact, coming up, they could be a little bit lower. Okay, I hope that is a good baseline, because where I want to take this next is to share a little bit about where we are at so far here this year as we've gone through kind of the first earnings reports here in 2023, which of course is looking back, so keep that in mind. So right now we've seen a huge majority of companies already reported earnings, and it's somewhere just barely under 70% of them, of the S&P companies in the S&P, by the way, make sure to clarify that, have beat earnings expectations. Now, what is really important is that most of the time, the majority of companies beat those earnings expectations. Typically, that is more of the standard than the other way around. Okay, so this is basically, quite honestly, it's a little more in line with typical numbers, about under 70% of companies beating the expectations, but it is quite a bit below the prior year. So if we go back over the last 4 quarters, this percentage of companies that have beat expectations is quite a bit lower than what we've seen looking backwards. More importantly, I think this is the biggest thing to consider right now, is that these earnings expectations from analysts priced in a decrease in earnings, right? So keep that in mind. All of these earnings expectations are based on a much lower threshold. Analysts thought that earnings were coming down. And some are reporting even lower than that. Which basically means that companies are dropping more than expected, right? Their revenues, their earnings are dropping more than many analysts already had figured would decrease. Right now, the decline in earnings year over year is just under 5%, I believe, like across the blended index there. So, it's really important to watch that. And it's nothing out of left field. I think, again, analysts expected it. I think, everyone kind of expected this to be a tougher earnings season. But it is important to watch, and especially if a lot of companies are missing the mark even on those lower expectations, it's something to really keep an eye on. In addition, as I had mentioned before, companies offer guidance. They're offering what they see coming down the pipe. And this is really, really important, because what this shows is really what the companies are seeing in the future, what challenges or opportunities they see down the road. Right now, many companies have have issued negative guidance. So in other words, they are saying, okay, here are our earnings, here are our sales, and moving forward for the year ahead or the quarter ahead, we actually expect that there's some challenges, and we may drop that earnings guidance down the pike there. So there are a few that have offered positive guidance, but really the skew right now is significantly more to companies offering negative guidance in the coming quarter or year ahead. So this is huge at a time like this, because we are watching the market conditions moving forward, right? Again, as stocks are priced, we're looking ahead. The reason this is so important is because we have a lot of challenges right now. We've got interest rates, we've got inflation, we've got consumer spending,